Are low interest rates really just a mirage? Hello and welcome to today's Daily Blitz. In today's video, we'll be having a brief discussion on a phenomenon that we've seen recently occur in developed economies over the past year. Now, this is regarding a government debt auction. So this is where the government is directly borrowing money from the investment market in order to finance itself, to pay its employees, to pay for welfare, for defense, etc. Now, recently, some strange things have been going on, right?
Yeah, in the secondary market where investors trade government bonds, government debt, the price has been very high, meaning the interest rate's been very low. But when governments actually try and borrow at those interest rates, things start to go wrong. So, for example, in the last few months, the USA's tried to sell debt, and the bid to cover ratio, meaning the amount of people willing to lend it money, has fallen to 10-year lows. A similar thing happened in Japan. In Australia, just I think last week, actually the bond auction failed completely, where the government was not able to borrow the amount of money that it had planned to because investors weren't willing to lend it. And a similar thing happened in Germany a few months ago, where the government tried to auction off 2 billion euros worth, and less than half of that actually sold, meaning investors just weren't willing to lend it the money.
Right, so it's a quite strange discrepancy, really, because you always hear about, there's a great, really strong bond market ever since the financial crisis, really. But it seems like when it actually comes to the primary market, when, there's the initial transmission mechanism where the government really actually gets financed to begin with before the bonds get sold on and traded and bought by other investors like investment funds, it seems that there's an issue there just with the willingness of the primary participants in the bond market to finance the government, right?
Yeah, and what this suggests is that if governments actually tried to increase spending substantially, say to finance a Green New Deal or fiscal stimulus, they would not be able to borrow the money at the current interest rate. It's almost like a mirage. Those interest rates are not the real interest rate that the government could borrow at once it tried to.
This is something that investors really should bear in mind because it's becoming ever more popular by political parties all across the developed world, really, to look for big fiscal stimulus plans, big infrastructure plans, Green New Deals, etc. If it actually turns out that when they actually, there's the political will to do it, and yet they can't actually pay, for whatever it is, it seems like there would be really quite a big crisis there.
Yeah, and the risk is that the interest rates that rise in the government bond auctions actually end up transferring to the rest of the economy, causing a spike in interest rates for companies as well.
Right. So, when you think about it, do you think the bond market could enforce austerity?
It's possible, but I think I'd prefer to describe it as the bond market being very fragile. The politicians think they can borrow the money. The central bankers think they can borrow the money, but when they actually try and do it, they find out they can't.
Well, thank you very much for watching today's Daily Blitz. I hope you tune in tomorrow for the next one. Thank you very much for watching.